Good morning and welcome to my office. Let's get started.
The COMEX isn't a market. It's an illusion, a sleight of hand where Wall Street sells 400 times more silver than physically exists in their vaults, and they're counting on you never asking for delivery. As of February 2025, COMEX has 400 million ounces of silver represented in open futures contracts. But registered inventory, the metal actually available for delivery, is 1 million ounces. That's 400 claims on every ounce. If just 0.25% of contract holders demand physical delivery, the system runs out of silver. Not might run out. Mathematically must run out. This is fractional reserve banking applied to bullion, and it's perfectly legal until it breaks. How is this allowed? Regulatory capture. The CFTC, Commodity Futures Trading Commission, is staffed by former Wall Street executives who wrote the loopholes. But the illusion is failing. Delivery demands are rising, inventory is draining, and when the ratio hits 500, 1, or 1,000 to 1, which we're approaching, the system breaks. In the next 5 minutes, I'll show you the exact math behind the 400-1 ratio, how Wall Street creates silver out of thin air, why regulators allow it, who profits from the scam, and the timeline to when this illusion collapses. Because you're not just learning about silver, you're learning how wealth is manufactured from nothing, and how to position yourself before the trick is exposed. Let me show you the exact numbers. This isn't theory. This is COMEX's own data. Open interest, February 2025. COMEX Silver Futures. Open interest stands at approximately 80,000 contracts. Each contract represents 5,000 troy ounces. Total silver represented, 80,000 is 5,000, or 400 million ounces. This is the paper silver outstanding, the claims on metal. Registered inventory, February 2025. COMEX reports two types of silver in vaults: registered, available for delivery, and eligible, stored, but not available for delivery. As of February 2025, registered silver, 98 million ounces. But here's the critical nuance. Not all registered silver is truly deliverable. Some is encumbered, already claimed, but not yet shipped. Some has quality issues. Some is inaccessible due to vault logistics. Industry insiders estimate truly deliverable silver at 1 to 5 million ounces on any given day. Let's be conservative and use 1 million ounces as the floor. The ratio, 400 million ounces, paper claims, 1 million ounces, deliverable physical. Floor is 400.1. For every physical ounce that can actually be delivered, there are 400 paper claims on it. Even using COMEX's official 98 million Oz registered figure, 400 meter, 98 more, 4.08.1. But this assumes all 98 min Oz is instantly deliverable, which it's not. The real ratio is 101 to 401, depending on vault logistics on any given day. What does this mean practically? If 0.25% of open interest, 1,000 contracts from around 5 million open Oz demand delivery simultaneously, COMEX cannot fulfill without draining multiple vaults, triggering delivery delays, or declaring force majeure. The illusion depends on 99.75% of traders settling in cash, never demanding physical. But that assumption is breaking. How does Wall Street sell 400x more silver than exists? Through fractional reserve bullion, the same mechanism banks use with your deposits applied to precious metals. Step 1. Create paper contracts. COMEX authorizes banks, market makers like JP Morgan, HSBC, to create silver futures contracts. These contracts are promises to deliver 5,000 Oz at a future date, but banks don't need to own the silver when creating the contract. They just need margin collateral, typically 5 to 10% of contract value. Step 2. Sell contracts to speculators. Retail traders, hedge funds, and institutional players buy these contracts. They're not buying silver, they're buying price exposure. 97 to 98% will close positions before expiry and settle. In cash. Banks know this, so they can sell far more contracts than physical exists. Step 3. Recycle the same silver. The 1.5 million Oz of truly deliverable silver rotates. A trader demands delivery, gets 5,000 Oz shipped. 2 months later, they sell it back to COMEX, or it's returned to eligible status. That same 5,000 Oz backs 2050 new contracts. The metal is recycled, but the paper claims multiply. Step 4. Manipulate price through paper selling. When silver threatens to spike, demand rising, supply tight, banks dump 20,000, 30,000 paper contracts in minutes. This crashes the price. Retail panics, sells, banks buy. Back contracts at lower price, profit on the short. No physical metal ever moved, pure paper manipulation. Step 5. Pray no one demands delivery en masse. The entire illusion relies on settlement in cash. If 5 to 10% of open interest demanded delivery, COMEX would declare force majeure, act of God clause, suspend delivery, or cash settle at manipulated low price. The Hunt brothers, 1980, forced COMEX's hand by demanding delivery. COMEX changed rules mid-game, banned new long positions, forced liquidation. Delivery demands, Primar's existential threat to the illusion. This is how Wall Street manufactures silver from nothing. Paper contracts, minimal physical backing, price, manipulation, and prayer that no one calls their bluff. It's legal because regulators allow it. And it's failing because industrial users and Eastern buyers are demanding physical. How is selling 400 times more silver than exists legal? Because the people who wrote the rules profit from the scam. Loophole number 1, bona fide hedging exemption. The Commodity Exchange Act allows unlimited short positions if they're for bona fide hedging purposes. Banks claim they're hedging client exposure or inventory risk. In reality, they're naked shorting, selling contracts without owning metal or having legitimate hedging need. But the CFTC rarely challenges hedging claims. Loophole number 2, no delivery requirement. Futures markets don't require sellers to own the underlying asset when creating contracts. You can sell silver futures without owning silver as long as you post margin. This allows infinite paper creation. Compare to stock markets. You can't short sell stocks without borrowing them first. Locate requirement. Commodities? No such rule. Loophole number 3. Position limits are voluntary. The CFTC sets position limits on how many contracts one entity can hold, but enforcement is weak. Banks use multiple subsidiaries, offshore accounts, and client flow to circumvent limits. JP Morgan has been fined repeatedly for spoofing and manipulation, yet continues operating with minimal oversight. Regulatory capture. The CFTC is staffed by former JP Morgan, Goldman Sachs, and CME Group executives. Bart Chilton, former CFTC commissioner, deceased 2019, openly stated that silver markets are manipulated, and regulators know it but lack political will to act. Gary Gensler, former CFTC chairman, now SEC chair, implemented position limits in 2011, but they were overturned by courts after industry lawsuits. The revolving door between regulators and banks ensures no meaningful enforcement. It's legal because those who profit from the illusion write the rules and staff the agencies. The fraud is systemic, institutional, and protected. But protection only works until the math breaks, and we're at the breaking point. Who makes money from the COMEX illusion? Follow the paper trail. Profiteer number 1, JP Morgan. Largest COMEX silver short seller, historically, fined $920 million in 2020 for spoofing and manipulation, admitting to thousands of instances over 8 years. But while manipulating paper, priced down through shorts, JP Morgan simultaneously accumulated 180 million Oz of physical silver between 2011 and 2020, documented by analyst Ted Butler. Strategy: short paper to crash price, buy physical at discount, cover shorts, profit twice. They're betting paper goes to 0, physical goes to 150 plus. Profiteer number 2, HSBC, major COMEX market maker. Fined $27.4 million by UK Financial Conduct Authority in 2024 for front-running client orders and manipulating silver prices 2010-2014. Operates as custodian for SLV, iShares Silver Trust, controlling 600 million Oz of paper silver while shorting COMEX. Conflict of interest is the business model. Profiteer number 3, Citadel and HFT firms. Execute the algorithmic dumps that crash prices. Make money on spreads, volatility, and front-running retail orders. They're not betting on silver direction. They're extracting rent from every transaction through speed and information advantages. Profiteer number 4, CME Group, COMEX owner. Collects fees on every contract traded, more paper trading, more revenue. CME has zero incentive to limit leverage or require physical backing. The illusion is their profit center. In 2024, CME Metals division generated $487 million in revenue, 90% from paper trading, only 10% from physical delivery fees. These aren't speculators or investors. These are institutions that profit from manufacturing silver from nothing, manipulating its price and ensuring the illusion never breaks until it does. And when it breaks, they'll be holding physical, while retail holds paper claims worth 0. When does the 400.1 illusion break? When delivery demands exceed the recycling capacity. Current state, February 2025. Delivery rate, 7.2% of open interest, historically 2 to 3%. Industrial users demanding physical for solar EV production. Registered inventory, 98 MONs, down from 136 MONs, January 2023, a 28% decline in 24 months. Ratio already at 4:1 officially, 100-401 realistically. Phase 1, Mar-June 2025. Ratio stress. If delivery rate hits 10% plausible as industrial demand surges. That's 40,000 contracts, 200 MOZ, demanding delivery annually. Registered inventory would need to recycle 2x per year minimum. Delays appear. Vault congestion. Processing backlog. First signs of stress. Phase 2, Joule Deck 2025. Inventory crisis. Registered inventory drops below 60 mmR Oz. Delivery rate 12-15%. COMEX can't fulfill without declaring some metal ineligible for delivery or imposing delivery delays of 6 to 12 weeks. Premiums on physical silver spike to 15.25 over spot. Paper physical divergence becomes obvious. Phase 3, Q1 Q2 2026. The break. Registered inventory below 40 M Oz. Delivery rate 20% plus. COMEX faces catastrophic shortage. Options? 1. Declare force majeure, suspend delivery, cash settle at manipulated price. 2. Implement Hunt Brothers style rule changes, ban delivery, force liquidation. 3. Let price spike to $100, $150 to ration demand. Likely outcome, combination of 1 and 2. Paper contracts settled at $30, $40. Physical trades $100, $150 on parallel markets. Timeline, 12-18 months until break. You're in the window where exiting paper and buying physical is still possible at reasonable premiums. After phase 3, paper is worthless, physical unobtainable. Position now, the 400.1. Illusion has broken before. Let's examine the Hunt Brothers case, the last time someone forced COMEX to show its hand. Setup, 1973, 1979. Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires, decided to corner the silver market. They bought futures contracts and demanded physical delivery. Between 1973 and 1979, they accumulated 100 million ounces of physical silver, roughly 50% of global deliverable supply. Silver price, $6, 1979 to $49.82, January 1980. The squeeze, 1979-1980. The Hunts kept demanding delivery. Every month, millions more ounces. COMEX was hemorrhaging physical. By late 1979, it was clear. If the Hunts continued, COMEX would run out of deliverable silver. The 400.1 illusion, ratio was similar then, was being exposed. Industrial users couldn't get metal. Panic set in. COMEX's response, January 1980. On January 21st, 1980, COMEX implemented Silver Rule 7, emergency regulations that 1. Banned new long positions above 3 million Oz. 2. Prohibited delivery on existing contracts. Forced cash settlement. 3. Raised margin requirements, 507.50%. The Hunts were forced to liquidate. Silver crashed from $49 to $10 in 3 months. The lesson, COMEX will change rules mid-game to protect the illusion. When delivery demands threaten the fractional reserve, they'll suspend delivery, force cash settlement, or implement position limits. Paper holders get screwed. The Hunts lost $1.7 billion, but here's the key. They lost because they held paper contracts COMEX could manipulate. If they'd only held physical and never used COMEX, they'd have won. Today's takeaway, don't hold paper claims. Hold physical metal. The 2025 difference. In 1980, it was 2 billionaires. Today, it's industrial users, solar companies needing 200 NEM Oz a year, central banks, China, Russia accumulating, and retail, Wall Street Silver 240K plus members. COMEX can ban 2 billionaires. Can it ban China? Can it ban solar industry? The illusion is facing a multi-front assault. How do you protect yourself from the COMEX illusion collapsing? Position number 1, exit all paper silver, immediate. Sell SLV, close COMEX futures, withdraw from bank. Unallocated accounts. Accept the current paper price. Don't wait for the illusion to break. You'll be stuck in forced cash settlement at manipulated lows. Position number 2, buy physical silver this month. American Eagles, Canadian Maples, 10 Oz bars. Accept premiums, $3.05 over spot, or $35.37 all in. These premiums reflect reality. Physical is scarce, paper is abundant. When COMEX breaks, your $35-$37 physical will trade at $100 to $150, while paper holders get $30 to $40 cash settlements. Position number 3, take personal possession. Don't store with banks or in unallocated vaults. The entire point is exiting the paper system. Home safe, private vault, or allocated storage only. Bullion vault, PSLV, where you own specific bars. Position number 4. Understand you're early, not wrong. The 400-1 ratio has existed for years. Why hasn't it broken yet? Because 97-98% still settle in cash. But that's changing. 7.2% delivery rate now versus 2 to 3% historically. The illusion breaks slowly and suddenly. You're positioning before suddenly. Timeline. If you position now, February 2025, you're 12 to 18 months ahead of the break. You'll pay $35, $37 for metal that's worth $100, $150 post-break. If you wait until after COMEX declares force majeure, phase 3, you're paying $80, $100 in premiums or stuck in paper. Don't be late. The COMEX illusion: Wall Street sells 400 times more silver than exists, 400 million ounces of paper claims, 1 million ounces of deliverable physical. The math doesn't work. It never did. It only functions if 99.75% of traders never demand delivery. But delivery demands are rising. 7.2% now versus 2-3% historically. Industrial users need physical for solar panels and EVs. China and Russia accumulating strategic reserves. Retail waking up to the scam. The 99.75% assumption is breaking. How is this legal? Regulatory capture. Loopholes written by banks. CFTC staffed by former JP Morgan executives. Fines or cost of doing business. 920 voters for JPM. 27.4 employers for HSBC. Pocket change versus profits. Who profits? JP Morgan accumulated 180 Malware Oz physical while shorting paper. HSBC, custodian for SLV while manipulating price. Citadel, HFT rent extraction. CME Group, 400 Sinom's annual revenue from paper trading. When does it break? 12, 18 months. Phase 1, ratio stress. Happening now. Phase 2, inventory crisis, mid-2025. Phase 3, the break. Q1, Q2, 2026. Hunt Brothers precedent shows COMEX will change rules to protect itself. Paper holders will be cash settled at manipulated prices. Physical holders will sell at real market prices. What do? Exit paper now. Buy physical this month. Take possession. You're not buying silver. You're exiting the illusion before it collapses. Full COMEX data, regulatory history, Hunt Brothers case study, and positioning timeline linked below. Educational content, not financial advice, but the math is the math. 400.1 doesn't work. And you know it now.